Welcome to AM Best Audio.
Welcome to this AM Best special presentation, How Insurers Are Addressing Earlier Low-Rate Investments. I'm Lori Chortis for AM Best TV. Companies have been confronting a dynamic environment where historically low interest rates challenge the traditional investment strategies of insurance companies. Our panel of experts will explore the innovative approaches insurers are employing to navigate this terrain, ensuring the stability and growth of their portfolios while meeting the evolving needs of their stakeholders. And now let's meet our panel. Joining us today is Cindy Beaulieu. She's the CIO at Conning North America. Also joining us is Ken Griffin. He's a managing director and head of insurance solutions at Barings. And Siobhan Bardner is the CEO and co-founder of AM Specialty Insurance Group. Welcome, everyone. It's so great to see you. Thank you so much for joining us.
It's a pleasure to be here.
Great. Absolutely.
Thank you. Siobhan, let's kick off the discussion with you. How did the persistent low-rate investment environment influence insurers' approach to underwriting and pricing strategies?
The low interest rate environment coincided with extremely low insurance rates, which created a soft insurance market cycle. Insurers had become used to low interest rates, which put pressure on the insurance model. I would say that the low rate investment environment, therefore, has made it significantly more important for insurance companies to focus on technical underwriting standards and pricing adequacy. Putting together a framework where business is underwritten on a technical basis with rate adequacy for profit protects a company's surplus, which will bolster profitability regardless of the economic cycle. As reinsurance has become more difficult to purchase, it's extremely important for companies to write business with a view to minimizing the downside. So recently, the rate environment has improved considerably, as has the investment environment. The economy has transitioned very quickly from a low rate environment to a higher rate environment, which would be a benefit to the insurance sector. However, it's still very important to focus on technical underwriting capabilities and underwriting for a profit. In our case, Simon and I have come out of the London market. We have had a very strong technical underwriting training, and that has created deep industry experience. As a result, we're able to focus on technical underwriting standards within our company. We won't write business where we don't have technical underwriting capabilities. We write business to a specific model. We avoid nat cat and severity business. Our priorities remain the same regardless of the rate environment. And really, it's about prioritizing strong underwriting results and producing growth over the long term.
Ken, how are insurers dealing with low book yielding securities purchased when rates were near historic lows?
Well, I would say largely insurers don't need to deal with low book yielding securities. While they may have been purchased when rates were low, their current market yields are high in today's higher yielding environment. So from today's economic standpoint, returns generated from these assets are attractive compared to recent years when rates were at all-time lows. Of course, from an accounting standpoint, many fixed income securities are trading in a loss position since market values have fallen, but this isn't of great consequence to insurers unless there's a liquidity event that unexpectedly forces the sale of assets. This isn't to say that there's not a preference to have more funds available for initial investments in this higher rate environment, for improved total return performance and to have avoided the market value losses over the past year. But this is an asset-only viewpoint and doesn't necessarily consider that investments are made relative to the insurer's liabilities. So while the market value of assets have fallen, so have the market value of the liabilities that they support. Therefore, from an economic capital perspective for insurers, the economic capital should be relatively stable unless there's a bad duration mismatch between assets and liabilities. From a book income perspective, as it became clear that the Fed would start hiking rates, many insurers began positioning their portfolios to include more floating rate assets. So short rate resets would automatically increase income. This has obviously been a good trade, and now there are more conversations around hedging these floating rate positions with the Fed expecting to begin lowering rates. And so maybe on a final note, from a reinvestment perspective, I've heard from insurers that rates are so attractive now in vanilla corporate credit, they don't need to reach into higher yielding private markets. I would contend, though, that value obviously still exists in certain privates. And if you can afford to take the liquidity risk, higher yields are always important. And these should still be a part of your strategic asset allocation because your competitors are still reinvesting in these even higher yields. We've gone through and perhaps are still going through what may be considered a liquidity catastrophe with this huge rate spike. And yet insurers have largely managed very well. So we may look back at this period as evidence that insurers have even more illiquidity capacity than they once thought.
So, Cindy, is there a potential here for improving risk-based capital?
There actually is, and I think as listening to Ken's response there, a lot of that comes down to having some organic cash flow to put back into these markets, which certainly would give you the ability to improve the overall income profile of the portfolio you have today as you're putting new money to work. The challenge for some insurers is that they don't necessarily enjoy that level of organic cash flow, or they just see a need to try to reposition the portfolio for a variety of reasons. So there was a temporary rule change that the NAIC allowed for the admittance of negative IMR balances to be considered as an asset. And that's been really important. And we have seen several insurance companies jump right in and take advantage of that very early on. But as you think about it, the ability to sell a security at a loss and then actually be able to count a portion of that as an IMR asset in your total capital, adjusted capital calculation is very helpful and improves the numerator as the denominator decreases from the sold position. So you do have the ability to improve risk-based capital, and other ways to think about that are just given the overall environment, the ability to not necessarily have to go down in credit when you're trying to buy higher yielding securities. So that in and of itself will improve risk-based capital ratios.
We're going to take a short break, and when we come back, we'll look at the consequences of having assets with large market losses and so much more.
It insulates the portfolio, importantly, from changes in the economic cycle or other exogenous events that could hurt the portfolio.
Struggling with today's challenging investment environment? New England Asset Management tailors their services to the insurance industry's unique needs. Learn more by visiting neamgroup.com. That's NEAM group.com.
We're back, and we're talking with Ken Griffin from Barings, Siobhan Barter of AM Specialty Insurance Group, and Cindy Beaulieu of Conning. Cindy, are there opportunities when selling securities at a loss?
Yeah, there absolutely is. And I touched a little bit on that in my prior response about negative IMR. But what that has really allowed companies to do is to take advantage of the current interest rate environment. And there's been some really nice ways to do that. Markets right now are incredibly liquid. And what that means is there's an ability to sell securities today that may have been harder to sell in prior rate environments and prior market environments. And so when you think about securities where it might have a small total amount outstanding or a name that's a little bit less trafficked in because it's not in any of the major indices, those names are very easy to sell. So that gives insurers an opportunity to trim some names that they may not be comfortable holding anymore. We've also seen in this environment the compression of what we look at as credit curves. So when you think about moving from a single A security to a triple B security, you expect to get more spread on that higher risk environment. And then similarly, even more spread moving to double Bs. But what we've seen, because there's been so much demand for fixed income, is that those spreads have compressed. And so you're not getting paid anywhere near as much of a risk premium to buy that double B asset relative to a triple B, and similarly triple B relative to single A. So what does that mean for insurance company portfolios? portfolios, it means that they can actually improve their risk-based capital ratios by buying a higher quality security when replacing possibly a triple B or even a double B name. So that's certainly an improved environment. That's accretive to RBC. As I said, it insulates the portfolio, importantly, from changes in the economic cycle or other exogenous events that could hurt the portfolio. So certainly an improvement we're seeing there. And the other thing gets back to a little bit of what Ken was talking about earlier. We've seen a definite trend for the period really from the great financial crisis through early COVID, where insurance companies reaching for yield and trying to find it wherever they could, risk appropriate, of course, but the trade was to give up liquidity. And I agree with Ken in what he said earlier. There is absolutely still a place for giving up liquidity in portfolios, and some of those private assets and alternative assets are still very attractive. But the point is, you don't have to have that dominate your portfolio today the way it may have had to several years ago. And so insurers are able to buy liquid assets at very attractive yields. And you look out in the market today, and we're talking about buying things like agency and non-agency mortgages that are AAA rated between 5.5% and 6%. You're looking at investment grade corporates that are 5.25% and upwards of that 6%, depending on where you are on the curve. So there's absolutely a benefit to being able to sell securities at a loss, lower book yielding securities, and reinvest and build income nicely into insurance portfolios.
Ken, what are the negative consequences of having assets with large market losses on the insurance balance sheet?
Yes, well, there are potentially some negative consequences for insurers holding assets with large unrealized losses from a book accounting standpoint. For public insurers, selling bonds at a loss will impact stated GAAP income, so that may have some headline risk. I will say, though, for many years, as rates were drifting lower, the resistance to trading the portfolio was centered around avoiding taxable gains as well as degrading book yields. So there's been relief to see, this market shift toward accretive book yield trades. On the statutory side, life companies may be impacted by their IMR position, as Cindy mentioned. Interest maintenance reserve is an accounting nuance that captures realized gains and losses and amortizes them into investment income. This is really a way to stabilize insurance company capital. So taking gains doesn't artificially inflate capital just because interest rates have fallen. But when interest rates rise, like in today's environment, losses taken flow into IMR only to the extent that we're offsetting gains or a positive IMR balance, which means high realized losses can end up destroying statutory capital and harming the RBC ratio, but not economic capital. So this was a hugely recognized issue over the past year. So regulators gave the life insurance industry a temporary reprieve and allowed negative IMR balance up to 10% of capital and surplus. However, if realized losses are large enough, this temporary solution may be fleeting, and insurers can begin to have artificial capital deficiencies. So the regulators will certainly be revisiting this issue again to make adjustments.
Siobhan, in what ways did insurers diversify their investment portfolio to mitigate the impact of low yields? And how do these strategies align with their overall risk management framework?
It's been a challenge for the insurance industry to transition out of the sustained low interest rate environment. But this is a welcome development to the industry, as it's now possible for insurance companies to make higher investment income, which is a benefit to their bottom line. Part of the management of this cycle is dependent on the quality of business underwritten. If the business underwritten is profitable, it will make this transition easier, as it will allow companies more time to diversify their portfolio. Some insurance companies lost money when they diversified into equity investments, which carry significantly more risk than fixed income investments. Some purchased longer dated T-bills, which lost value when interest rates increased quickly. This is partly due to the extended length of the low interest rate cycle and then the sudden acceleration of interest rates, which was not really expected or anticipated. Transitioning out of equities needs to be handled with care and premeditation. It's important to have alignment between the insurance company and their investment manager. In this way, they can manage the cycle by trading out of low interest rate products with the least amount of downside risk. We've worked with our investment advisors with regards to the structure of our investment portfolio. We've been very lucky in terms of our timing with regards to the investment cycle. We did not have a significant amount of surplus already invested when our company was authorized in September 2022. Interest rates began to transition upwards very quickly after we were authorized, and we are extremely conservative. So as a result, we mainly held cash and real estate. So we were able to move out of a cash position, take advantage of the increased rate environment, and invest in the medium to short term. We did not invest in equities. Our real estate investments received a welcome bump as a result of inflation, which has moved our surplus higher. So that is a real benefit to the inflationary situation. We're really bond heavy. We hold no commercial real estate and no equities. So, we have a very conservative investment objectives. We take a concerted approach, and we review our investment portfolio regularly, but we would look to tweak rather than to significantly change any of our objectives within that. I think the really major thing about the insurance industry is about the long term. So we've been in this very low interest rate cycle. I think actually we'll be in a cycle where interest rates actually stay higher for longer, to take a note out of Bloomberg. But so therefore, I think the insurance industry has to anticipate that pattern and really transition out of this lower rate environment into a higher rate environment, and they will get a net benefit from that naturally as they transition across their investment portfolios.
You're absolutely right with rates going up. For so long, the insurance industry dealt with low rates, and we're somewhat in a panic over how low rates were dropping. So it's been a nice environment to see reinvestment rates at this level. But of course, the hard part was taking a rapid increase in rates, and that's what we've really gone through now. And there may be consequences for that. So we'll see.
We're going to take a short break, and when we return, we'll look at how the low interest rate environment affected insurers' capital allocation decisions and so much more.
So it's sort of like performing surgery on a patient, but only using a hammer.
Struggling with today's challenging investment environment? New England Asset Management tailors their services to the insurance industry's unique needs. Learn more by visiting neamgroup.com. That's NEAM group.com.
We're back, and we're speaking to Siobhan Barter of AM Specialty Insurance Group, Cindy Beaulieu of Conning, and Ken Griffin from Barings. Ken, earlier you mentioned economic capital not being impacted by accounting IMR. Are there times when economic capital may be impaired when rates rise?
Yes, good question. So we all recognize that the Fed has increased interest rates in an effort to control inflation toward a lower targeted rate. But I think there's currently less appreciation for the consequences of this. Rate hikes are an effective tool for controlling economic activity, but it is a very blunt tool, which will have consequences to economic sectors that are not necessarily to blame for higher inflation. So it's sort of like performing surgery on a patient, but only using a hammer. There will inevitably be collateral damage. So true economic damage to insurers can come in the form of increased credit impairments and defaults in their investments, where they're not paid back their invested principal should we get a downturn in the economy. So this would be a true economic loss in the value to insurers, and also highlights the need for experienced and proven asset management expertise to navigate what may become very choppy waters. Another potential economic impairment is where life insurers have allowed options to their policyholders to surrender their policies and get their full cash value back as rates spiked higher. But the insurer's investments don't prepay and, in fact, do the opposite. They may extend their maturities even longer in the case of mortgage-backed securities and callable bonds. Another name for this is convexity risk, and it does lead to true economic loss as the durations of the assets and liabilities become misaligned with asset values falling more than liability values. If surrenders by policyholders and their demand for their cash back is great enough, it could cause some liquidity stress to insurers if they're reluctant or unable to sell assets to pay their policyholders. This is what regulators are most concerned with, and a primary reason they want some floor on the amount of negative IMR allowed on balance sheets. Asset adequacy analysis, also known as cash flow testing, is an important regulatory requirement meant to have life insurers prove that the assets supporting their liabilities are sufficient under a variety of interest rate scenarios. And regulators have made more stringent revisions to this in recent years, for instance, through the adoption of Actuarial Guideline 53 and additional equity sensitivities. All of which is increasing the regulatory focus on the asset side of the balance sheet.
Cindy, are you finding that annuity writers are running into some unusual headwinds as a result of current market conditions?
It's been an interesting time in the annuity space. You think back to the period when rates were so low, and variable annuities were really the way to go, with the hopes that, constant hope really, that rates were eventually going to rise. And so you would get a benefit of that. But we obviously didn't see that happen for a very long period of time. And then suddenly rates did start to rise. And what we really noticed was a significant shift from the sale of variable annuities to fixed rate annuities. And that has really dominated the marketplace. You look at the period from 2018 to 2022 alone, and fixed annuity sales are up 110% in that time frame. If you look at from 2018 to 2024, we've seen crediting rates go up by 250 basis points. So there's good reason to want to participate in fixed annuities. They've certainly had their competition, though, and this is a little bit of the push-pull in the market. With an inverted yield curve, it's hard to get people off the sidelines when they see a cash yield that is so attractive and chalk them into trying to buy something that really is there to serve them for the longer term, but it has a lower yield. That becomes a little bit of a challenge to get investors to think that way and to buy policies along those lines. But the bigger challenge that we look at now is you think about fixed rate policies and you think about the crediting rates that they are putting out there today, and the ability for the investor of those assets to achieve the yield appropriate for that crediting rate over time. So as yields potentially fall, it could become more problematic for some of these fixed annuities that are out there at higher guaranteed rates, which could cause insurance companies to then obviously have to increase their reserve levels, which is not necessarily a situation you want to be in. But I will say there's a counter to that, which does actually agree with what Siobhan was talking about earlier. We also believe that rates are expected to be higher for longer here, and that the curve is going to normalize. So there will be less competition of those short money market rates looking as attractive as we see the front end of the Treasury curve move lower. And we do expect that long-term rates will gradually move higher. And there's some more structural reasons for that, economic growth reasons and inflation reasons why we think that that could be the case. So fixed annuities definitely have a place in the insurance market. The real challenge right now is making sure that those crediting rates are achievable when you're thinking about investing the assets behind them.
Siobhan, when you look at the low interest rate environment, how has that affected insurers' capital allocation decisions, especially concerning growth and shareholder value creation?
There's a balance to allocating capital towards growth opportunities versus the need to ensure robust capital reserves now that interest rates have increased and it's possible to secure an improved investment income stream. Again, technical underwriting is the key to management of capital allocation decisions. Each class of business underwritten needs to stand up to scrutiny and be profitable. Due to the difficulty with purchasing reinsurance, companies need to look at classes of business underwritten almost on a net basis to make sure that they stack up in terms of profitability. Claims management is also key to adequate reserving practices to make sure that there is sufficient surplus to address claims needs. Finally, a low interest rate environment during a low interest rate environment, there is value in internal capital investment in innovations that provide enhanced value to partners, such as software, advanced analytics, and additional services. However, priorities change when companies can secure investment income due to higher rates. It's about having the expertise to weigh up the value of the investments in the company versus external investments. And really, that is a challenge for companies to look at. The return on internal investments as opposed to the return on external investments can often create a clash within the company. There's a huge attraction if you can deploy capital into the markets and get a really good return on that versus, building out aspects of your company. With regards to our company, we're privately owned. As Simon and I are shareholders, we have no external pressure on growing our company. I'm sure in this current environment, there is a lot of pressure, but as people on this panel have discussed, liquidity is a serious challenge in this market. Raising cash is a real challenge. That lenders have really receded from the market at this time, and it's put a lot of pressure on capacity within the market in general. Capacity is very difficult to access, and so this has kept rates higher. I think that this will continue to be bolstered as interest rates continue to stay high. I think it will keep pressure on the market and keep the market really in a hard market cycle. So this has plus and minus benefits to various companies. Going back to, investment approach, it's very important for companies to have a conservative investment approach. Our strategy is the same regardless of the interest rate cycle. We started our company in a low interest rate environment with our underwriting model in place that focuses really on underwriting profitability. As we've transitioned into a higher rate environment, it's been that has been a bonus to our company. Our focus is always on long-term growth, and we put a very strong emphasis on reserving. As Cindy has mentioned, reserving is very key as companies have to transition and juggle a lot of these aspects of, potential negative investments, looking at casualty and property rates that have quickly increased, but at the same time, so has claims costs. So these are challenges that companies really need to look at and really reserve adequately to try and help them out of this quickly developed position that's occurred as a result of, acceleration of interest rates. I really feel that interest rates are going to be higher for longer. I think once inflation gets into a cycle in an economy, it's going to be extremely difficult to trade out of that inflationary environment. Not only that, if you look at the world economy, every country in the world is really suffering from acceleration of inflation. And so the idea that the Fed is going to quickly drop rates back, I think is an extreme challenge. So these are all things that the insurance industry has to look at and plan for, and then, benchmark out over the longer term. So it is definitely a challenge, but I think the benefit is that as insurance rates have increased, now companies are actually able to make genuine profits from the classes of business that they're underwriting. And this is a true benefit because it really does buy them time in order to get their books to a profitable level. And from that point, then they can really have, the breathing room to look at the structure of their investment portfolios and manage that position.
I would just add to Cindy's comment about annuity sales in the life industry, and I made a couple of comments about liquidity or illiquidity not being a huge concern, and the industry's weathered it fairly well. I would say though that some of this weathering is coming from strong premium inflow from annuity sales. So it could be that some of the illiquidity concerns are being salvaged with the strong premium inflow. Now, what that's going to mean, though, is it's going to, when you price new products, you should be investing in today's environment and not using those proceeds to pay for old surrenders or surrenders of old policies. And so I think we're going to see, it'll be an interesting time over the next few years to see, how life companies have really behaved. And also I would say that they're starting to become a greater split as to who's writing new business and who isn't. So there are some companies that aren't growing as much as others, and so I think we're starting to see some differentiation in the life space, and particularly the annuity space.
I think I would just add to all of that is, listening to both Ken and Siobhan here, I think what it comes down to is that SAA work, that strategic asset allocation. Ken mentioned it early on in the program, and Siobhan was talking really about the importance of that type of work when you're thinking about managing insurance companies, because you can't just look at the assets, you can't just look at the liabilities, you have to look at them in tandem. And when you think about going through different economic scenarios, different interest rate scenarios, you need to take both the assets and the liabilities through those to understand how they work with each other. And that's really a critical part of laying out the appropriate strategy for investing those assets for the longer term. It's something that we work very closely with our clients on here at Conning, and I think it's really benefited us through these cycles and our clients through these cycles that we've been through. And as Siobhan is saying, we would agree that the current cycle we're in now looks like it could be with us for a little while longer, if not maybe a more permanent one of higher inflation for a much longer period of time.
Well, this has been a wonderful discussion, and I'd like to thank our panelists for an outstanding presentation today. And we'd like to thank NEOM for sponsoring today's special presentation. Thank you so much for joining us. For AM Best TV, I'm Lori Chortis.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.